Thank you very much, Mr. Chairman. In your testimony, Mr. Barr, you indicated that you were going to be, in one of the aspects of what you're working on, you're going to be looking at whether more stringent standards are needed. And I want to follow up on Senator Warner's questions relating to this argument that has been put out there, I think, as a part of the blame-shifting game, and there's a lot of that going on right now, that it was a statutory failure. That brings us to the 2018 reforms, Senate Bill 2155. And I just want to read to you a couple of sentences out of Senate Bill 2155 with regard to the question of whether that legislation prohibited our federal regulators, and particularly the Fed, from doing anything they needed to do with regard to applying the appropriate strict standards. And to start out with, I will read what Senate Bill 2155 did was to stop a one-size-fits-all system and mandate, by changing the word may to shall, mandate that the Federal Reserve tailor its regulations to the risk and so forth. I want to read the language. It mandates that the Federal Reserve differentiate, as it tailors, differentiate among companies on an individual basis or by category, taking into consideration their capital structure, riskiness, complexity, financial activities, including financial activities of their subsidiaries, size, and any other risk-related factors that the Board of Governors deems appropriate. And then at the conclusion of the statute, of that section of the statute, it makes it crystal clear, and this is the statutory language. Nothing in subsection A shall be construed to limit the authority of the Board of Governors of the Federal Reserve System in prescribing prudential standards under this section, or any other law, to tailor or differentiate among companies on an individual basis or by category, taking into consideration their capital structure, riskiness, complexity, financial activities, including financial activities of their subsidiaries, size, and any other risk-related factors that the Board of Governors deems appropriate. And I could go on with multiple times that language was repeated. My question to you is, was there any statutory restriction faced by the Federal Board of Reserves as it issued its regulations on tailoring that would have prohibited them from applying the strictest standards they could to address the prudential needs of our banking system?
Thank you, Senator Crapo. I agree with you. There was substantial discretion under that act for the Federal Reserve to put in place tailoring rules that were different from the tailoring rules that it put in place in 2019. I think there is still to this day a substantial discretion in changing those by notice and comment rulemaking. That's one of the areas that we'll be looking at in our review, whether there should be appropriate changes. There are some areas for, particularly for smaller firms between 50 and 100 billion, where the act is more prescriptive. But for the firms of the category that we're addressing today, there's substantial discretion for the Federal Reserve to change those rules in a way that is supportive of safety and soundness and financial stability.
Thank you, and I appreciate your answer. You said recently that the bank failed, referring to SVB, as the public began to focus on changes in values of securities in the bank's held-to-maturity account. That's correct, right? My question to you there is, did the standards on that risk that are used for supervision, were those changed at all in Senate Bill 2155 in 2018?
The standards for capital rules are determined by the bank agencies. The bank agencies made a decision to, for smaller categories of these large banks, to not require the pass-through of AOCI into the capital structure. But that was a decision that is available to be altered by the discretion of the bank agency.
And was not mandated by 2155?
No, it was not mandated by 2155.
Last question is, under the current standards that are applied with regard to capital, was SVB adequately capitalized?
Prior to its failure, it was categorized under current capital rules as well capitalized.
All right, thank you very much.
Thanks, sir.